So, Tesla just announced a 5-for-1 stock split, and just recently, Apple announced a 4-for-1 split. What exactly does a stock split mean for these stocks? And more importantly, how can you profit from this? Let's take a look at some historic data on stock splits, and make sure to stick to the end of this video to learn how you can make money on this. So, why do we have to split stocks in the first place? What happens if you never split the stock? Well, then you end up with the Berkshire Hathaway Class A stock with a price of over $300,000. Ooh, just realized that we could have picked it up for under $250,000 in March. What a steal! Well, anyway, widely inaccessible to the smaller investors. So by splitting a stock, one share would be more affordable to the smaller investors and the transaction cost per share would be lower. And this is also the reason stated by Tesla that they want to make the stocks more accessible for their employees and small investors. So in these splits, each Tesla shareholder will receive an additional 4 stocks per every 1 stock they own now, effective on August 31st. And each Apple shareholder will likewise receive 3 more shares per owned share, effective on August 24th. This is actually a form of dividend, but instead of getting money, you get shares. This doesn't mean that you will get 3 or 4 times more money worth of stocks now. The value of your investment is still going to stay pretty much the same, but the value of each share will be lower. This means that if you had one original share in a company worth say $500 and this company announced a 5-for-1 split, then each new share would be worth $100. So instead of having one share worth $500, you would have 5 shares worth $100 each, adding up to $500 in total. So this might seem a bit disappointing, but there is still a way you can make money out of this, so stay tuned. Now it's important to understand that the underlying value of the company has not changed by this. There will just be more shares available. So it's actually a bit of a mystery why, but stock splits are anyway associated with higher abnormal returns, meaning higher than normal returns. So I will take you through why stock splits generate higher returns and when you can gain the most on this. 2 major explanations have been put forward on why stock splits generate higher returns. The first one is the information or signaling hypothesis. This basically means that the stock splits conveys favorable new information to the market that wasn't known before. So naturally, there is an information asymmetry between the firm's managers and the outside investors. The inside managers just know more about the company than the outside investors with no actual insight into the company. While the stock split brings down the stock price to a more preferred trading range for investors, splits are more likely to be undertaken by managers who are more optimistic about the company's future prospects than by managers who are pessimistic about the future. Therefore, the split announcement is seen as a signal of a brighter future for the company. The lower the stock price will be after the split, the more optimistic and credible the managers are thought to be. This somewhat translates to the higher the split as well. This means that the future looks optimistic for both Apple and Tesla right now. So for Tesla, we would land somewhere just over $300 per new share, well, depending on where this ends. And for Apple, we would land at just over $100 per new share. So based on this, it looks like Apple is a bit more optimistic. The second explanation for the higher returns associated with the stock split is the liquidity hypothesis. This basically means that by lowering the price of one share to a more favorable range, more smaller investors will be able to buy it. And by attracting a wider pool of potential investors, the overall liquidity of the stock will be enhanced. This also lowers the liquidity premium, meaning basically that if the liquidity is lower, which happens when there is not so many stocks available to buy and there's not so many buyers, the investors want a premium to buy the stock, as it will be more challenging to get out of the position when they want to sell. So if there are more shares will likely be available for buyers, and this will then lower the liquidity premium. So the first major explanation, the information or signaling hypothesis, is contained in the announcement of the split and not the actual split itself. And it's indeed in the period between the announcement and the split that most of the abnormal returns are seen and the split is priced in. 1 year after the split announcement, abnormal returns have been seen to be just shy of 8% on average. And the larger part of these returns are produced in between the announcement and the actual split. These abnormal returns are also often higher for smaller firms, of where Apple and Tesla are not, obviously. And this relates to that the larger the firms, the more information is already known by the market, as larger firms have more analyst coverage already and greater visibility. Therefore, less new information is conveyed through the stock split. Abnormal returns of stock split announcements are also often higher in a bull market, where investors are more positive towards the general market. And at the moment the market is a bit more cautious, meaning that the effect of the stock split might not be as high right now. But fear not, my friends, because the abnormal returns tends to be higher for low book-to-market stocks or so-called glamour stocks than for high book-to-market stocks, also known as value stocks. If you haven't heard the term glamour stock before, this refers to a stock that is widely held and popular by investors. These stocks also tend to be more expensive as there is a higher demand for these popular stocks. And which stock is the glamour stock number one right now, if not Tesla? Well, this is after Kodak, of course. No, just kidding. And Apple also counts among the glamour stocks and has long been popular. So there is good hopes of higher return for both of these stocks. So how can you make the most money from a stock split? Hurry up and buy the stock now, as soon after the announcement as possible. That is, if you can't go back in time and buy them before the announcement, because that would absolutely be the best. Hit a like if you appreciated this video, it will help me out tremendously. And subscribe for more content on how the stock market really works. And continue to learn more by watching the video appearing on the screen right now or linked in the description. References used for this video are also in the description if you want to read more about the stock splits. Thank you so much for watching all the way to the end, and see you all next time.